If you're new to investing and spinning your wheels trying to figure out what to buy, then I get it. I used to feel the exact same way, but it doesn't need to be that way. You don't need to be a Forex trader or find the next Nvidia. If I had to start investing again in 2026 from scratch, there are just 3 ETFs I'd buy to build wealth in the stock market. If you like the sound of that, then take a seat, tap the thumb icon, and let's get straight into it.
But I thought you needed a well-balanced portfolio of at least 5 to 10 stocks. Surely putting your money into only 3 investments isn't diverse enough.
That's a great point, and it's actually one of the main benefits of an ETF. So before we get into the 3 that I personally would buy, let's quickly cover what an ETF actually is. An ETF, or exchange traded fund, is basically a basket of investments. So instead of buying a single company like Tesla or Apple, when you buy an ETF, you're buying a portion of a fund that can hold hundreds of companies all at once. Think of it like buying a slice of the entire market, rather than just betting on one single stock. There are loads of different types of ETFs, ones that cover geographies, industries, and even different asset types. This built-in diversification is one of the main reasons that ETFs have become so popular recently. And it also removes a lot of the guesswork that comes with trying to pick just a single stock. The graph on screen shows the annualized growth rate of over 20% worldwide since 2008 for ETFs, now exceeding $14 trillion in assets under management invested.
Okay, now I know what an ETF is. What are the 3 that you would buy if you had to start over again?
First up is VOO. This is an ETF that tracks the S&P 500 and gives you exposure to 500 of the largest companies in the US. So instead of trying to pick just one winner, you're invested in companies like Apple, Amazon, and Microsoft all in one go. It's heavily weighted towards sectors like tech, financials, and healthcare, but at the same time does have exposure to many other sectors, making it a well-diversified holding. Historically, funds tracking the S&P 500 have returned between 8 to 10% per year over the long term, but of course that doesn't guarantee future performance. And one of the biggest advantages of this ETF in particular is the cost. VOO has an expense ratio of around 0.03%. So overall, for me personally, I think this is a great investment because it gives you exposure to key companies in a growth-driven region. Next up, we have SCHD, and this is one for our dividend lovers, and I'll admit I'm one of those people. SCHD focuses on high-quality US companies that constantly pay and grow their dividends. So instead of chasing risky high yields, it looks for financially strong businesses with a track record of returning cash to shareholders. Think of companies like Coca-Cola, Pepsi, and even Chevron. And for those of you that are new to dividends, it's essentially a cash payment that you receive generally on a quarterly basis, paid by the company to you just for being a shareholder. And while these funds may provide you with a smoother ride and regular income, they may not grow as quickly as more aggressive and growth-focused ETFs, especially under certain market conditions. Finally, we've got QQQ, which tracks the NASDAQ 100, giving you exposure to 100 of the largest non-financial companies listed on the NASDAQ. This is a much more growth-focused ETF with a heavy weighting towards tech and innovation. It has been ranked in the top 1% of large-cap growth funds, the second most rated ETF in the US, and has also been trading for over 25 years. With QQQ, you're getting access to companies like Apple, Microsoft, Nvidia, and Meta, businesses that are known for strong profitability and reinvesting heavily into the future. But that higher growth potential comes with a trade-off. QQQ tends to be more volatile than something like the VOO, meaning bigger ups and downs along the way. But the higher risk could come with potentially higher returns. Now, I'm not saying by any means that this is the perfect portfolio mix, but what I think it does give you is a well-diversified and simple to manage portfolio that personally has worked for me over the years. But just because now you know where to invest, it doesn't mean you're instantly going to make loads of money overnight. It's about following investing fundamentals and being consistent and patient, allowing your money to compound over the long term, because this is where these funds really perform. As always, thanks for watching. If you enjoyed this video, then be sure to subscribe, for more content like this every week.